This is the story of how a regular software company looked at the slow death of cash, made a wild bet against inflation, and accidentally created a new kind of bank. They swapped their dollars for Bitcoin, built a digital vault holding tens of billions of dollars, and ended up writing the blueprint for a whole new financial system. This isn't just about crypto anymore. This is about the reinvention of banking itself, happening right under our noses. It's a quiet revolution where code is replacing marble columns and blockchains are challenging traditional balance sheets. And it all started with a single, nagging problem. For decades, the playbook for a successful company was simple. Make money and hold that money, your cash, in a treasury. That cash was supposed to be a safe, stable asset. But sometime in the 21st century, that basic idea started to fall apart. Whenever an economic crisis hit, central banks around the world fired up the money printers, leading to a slow, creeping, but undeniable force: inflation. For a company sitting on billions in cash, this wasn't just a small problem. It was a full-blown crisis. This is exactly the dilemma Michael Saylor, the CEO of a business intelligence firm then called MicroStrategy, ran into back in 2020. His company was successful, profitable, and had over $500 million in the bank. But he realized that cash wasn't safe. He famously called it a melting ice cube that was losing its buying power every single day. The one asset that was meant to be secure was actively shrinking in value. And it's not just a problem for a multi-million-dollar software firm. It's a problem for everyone. Anyone with a savings account has felt that sting of their money buying less this year than it did last. The traditional financial system, built on government-backed currencies, was showing its cracks. Companies were desperate for an alternative, a reserve asset that wouldn't melt. They needed something that could hold its value over the long run, something outside the control of any single government. Saylor and his team started a global search for an answer, and what they found would not only change their company forever, but also lay the groundwork for a new kind of financial institution. In the summer of 2020, Michael Saylor made an announcement that just floored the corporate world. His company, MicroStrategy, would adopt Bitcoin as its main Treasury reserve asset. This wasn't some small speculative buy. The company started by converting $425 million of its cash straight into Bitcoin. It was a bold declaration that a decentralized digital asset was a more reliable store of value than the US dollar. At the time, people thought it was an insane gamble. Bitcoin was still seen as this volatile playground for retail traders, not a serious asset for a public company's treasury. But Saylor was all in. He argued that Bitcoin wasn't just an asset, it was the solution to the universal problem of money losing its value. In his words, it was digital gold, a secure, global, and scarce property that could protect their treasury in a way cash no longer could. What began as one big purchase turned into a relentless buying spree. Quarter after quarter, the company, which officially rebranded to Strategy Inc. in early 2025 to reflect its new focus, used its cash and then took on debt to buy more and more Bitcoin. By late 2025, that bet had grown to a staggering scale. Recent reports show its holdings have swelled to over 660,000 BTC. This digital hoard, acquired for around $49.35 billion, represents more than 3% of all the Bitcoin that will ever exist. Its market value swings wildly, but it has at times been worth over $70 billion. This move completely transformed the company. It wasn't just a software firm anymore. Its stock price, MSTR, started moving in lockstep with Bitcoin, effectively turning the company into a way for traditional investors to get Bitcoin exposure. They were no longer just building software, they were building a fortress of digital value, one Bitcoin at a time. This radical bet was the first step in creating something new, a company that, for all intents and purposes, was starting to act like a bank. Let's be clear. Strategy isn't a bank in the legal sense. It doesn't have a banking charter, and it's not taking FDIC-insured deposits. But if you look at how it operates, it's a masterclass in financial engineering that runs the same playbook as a bank, just with a 21st century twist. A traditional bank takes in customer deposits and then lends that money out to make a profit. Strategy does something similar. Instead of deposits, it raises capital by issuing corporate debt, like convertible bonds. As of late 2025, the company has raised billions of dollars in this way. But instead of lending that money out, it uses nearly all of it for one thing: buying more Bitcoin. This creates a highly leveraged buy and hold strategy. The company's massive Bitcoin holdings act as an enormous asset on its balance sheet. This digital treasury is so large that it dwarfs its liabilities, making the company heavily over-collateralized. That financial strength allows them to go right back to the capital markets, raise even more debt, and, you guessed it, buy more Bitcoin. It's a self-reinforcing cycle, a massive bet on the long-term appreciation of its chosen asset. Saylor himself has talked about their ability to withstand huge price swings, suggesting they are ready for deep drops in Bitcoin's price. This robust, asset-backed model is the heart of the new bank idea. It holds a fortress of pristine collateral, uses leverage to grow its holdings, and operates on a global digital standard. It's a strategy that has drawn both incredible praise for its audacity and sharp criticism for its risk. But whether you think it's genius or madness, there's no denying it created a blueprint. And now, others are starting to follow it. If you're finding this breakdown of strategies playbook as fascinating as I do, and you want to understand where finance is headed, take a second to subscribe to the channel. We break down these complex shifts every week, and by subscribing, you won't miss what's coming next. Strategy may have written the first draft, but a growing number of companies are now editing and expanding on that blueprint, each adding their own spin to the story of crypto banking. This is all happening on two parallel tracks: regulated banks slowly warming up to crypto, and crypto-native firms pushing to become regulated banks. The biggest move from the traditional world came in November 2025. SoFi, a fully chartered U.S. national bank, officially launched SoFi Crypto, becoming the first bank of its kind to offer direct crypto trading to its millions of customers. After being forced to pause its crypto services in 2023 to get its banking license, new guidance from the Office of the Comptroller of the Currency, OCC, in 2025 paved the way for its return. Now, SoFi members can buy, sell, and hold assets like Bitcoin and Ethereum right inside their FDIC-insured banking app. Just to be clear, the crypto itself isn't FDIC-insured, but putting it all in one place is a landmark moment. It signals that the wall between traditional banking and crypto is finally crumbling. While SoFi pushes from the inside out, crypto-native companies are pushing from the outside in. They're actively chasing the very charters that will give them the legitimacy of the banking system. The crypto exchange Kraken led the charge back in 2020 by securing a special purpose depository institution, SPDI, charter in Wyoming. This made Kraken the first digital asset company in U.S. history to get a bank charter. An SPDI is unique because it has to be fully reserved, meaning it must hold liquid assets equal to all of its customer deposits. This is designed to prevent the kind of bank runs that can happen with traditional banks. Others took a different route. In 2021, Anchorage Digital became the first crypto firm to get a conditional National Trust Bank charter from the OCC. While not a full commercial banking charter, it was a huge step. It established Anchorage as a federally regulated, qualified custodian, allowing it to hold digital assets for big institutional clients like other national banks, something many large funds were legally required to use. This race for legitimacy is heating up. Circle, the company behind the multi-billion-dollar stablecoin USDC, has also been pursuing a national banking charter to bring its operations further inside the U.S. regulatory fence. The ambition is clear: to become a fully regulated, transparent digital currency bank. These firms aren't just building apps anymore, they're building the regulated financial infrastructure of tomorrow. Even the giants of Wall Street are being forced to play along. While they're moving much more cautiously, firms like JP Morgan are heavily invested in the underlying technology. Through its blockchain division, recently rebranded as Connexus, JP Morgan is experimenting with tokenized deposits and collateral networks. It has already processed hundreds of billions of dollars in digital transactions on its private blockchain. The bank has begun tokenizing real-world assets like private equity funds, with plans to expand to real estate and private credit by 2026. And while some of the bank's own analysts have noted that the growth of tokenization has been slower than the hype, the infrastructure is being built. The next logical step, which many see as a matter of when, not if, is for these titans to offer services like Bitcoin-backed loans and compete directly with the crypto natives. The system is changing, piece by piece. What started with one company's audacious hedge against inflation has snowballed into a global movement. The evolution of a simple software firm into a de facto digital bank holding over 3% of the world's Bitcoin was more than just a corporate strategy. It was a proof of concept. It showed the world that a non-financial company could use a digital asset to build a balance sheet more resilient and powerful than many old-school financial institutions. This isn't a story about the end of banking. It's about the expansion of what a bank can be. We're watching a great convergence. On one side, you have regulated giants like SoFi carefully weaving crypto into the existing system, offering a familiar front door for millions. On the other, you have crypto pioneers like Kraken and Anchorage fighting for legitimacy, building a parallel system on new rails that are faster, more transparent, and global by default.
Of course, this new world is loaded with risk. The same volatility that creates so much opportunity for leveraged players like Strategy is also its greatest weakness. Regulatory uncertainty is a constant threat, and the whole idea of a company tying its fate to a single digital asset is a high-stakes experiment with no guaranteed happy ending. But the blueprint is out there now. The idea of a company using a global digital commodity as its main reserve asset, leveraging it to create value, and operating with a transparency that old world banks can only dream of is no longer just a theory. This is no longer just one company's big bet. It's a glimpse into a future where the very definition of a bank is being rewritten. The question is no longer if the financial system will change, but who will be the ones to build its next version.
What do you think the future of banking looks like? Is this the start of a more transparent and open financial world? Or is it a high-risk gamble that's bound to end in disaster? Let me know what you think in the comments below.